Good evening, everybody. Thanks for attending today's webinar. Florida Credit Union, my name is David Eckhart. I am the Senior Vice President of Operations. I'm very proud to introduce to you Mr. Ken Toops, and he is one of our FCU investment advisors, and he's going to cover saving for retirement, IRA, need-to-knows. Without further ado, here's Ken Toops.
All right, thanks so much, David. As David just mentioned, today we're going to be covering saving for retirement and IRA need-to-knows. We are going to open up for some questions towards the end. If you happen to see the screen to the right, there's a questions tab. And if you have a question during this presentation, if you want to just type it out, we will try to answer as many questions as we can when we wrap up. Without any further ado, let's get this show started. All right, so my name is Ken Toops. I've been a financial advisor here with the Florida Credit since 2011. I cover the Gainesville, the Lake City, and the Stark area, and my colleague Jerry Johnson will help you guys in the Marion County and DeLand area. So as I mentioned, we're going to have some time for questions at the end. I'm going to give you just a little bit of time right now if you want to grab a notepad and something to write with, if you want to just jot those questions down. Or like I said, you can go ahead and type those questions in, and we will address those when we finish the presentation. All right, so let's go over our agenda. So here's what we're going to cover today. First, we're going to talk about why it's important to save for retirement. Then we're going to talk about some how-tos, how to contribute to a traditional or a Roth IRA. We'll talk about rollovers, if it's right or if maybe it's not the right decision for you to do that. I know a lot of people have questions about required minimum distributions. We're going to talk about guaranteed income that can last your lifetime, and also passing these IRA accounts over to your beneficiaries. And then when we wrap up, we will summarize everything that we went over. So first, we all know the importance and how important it is to save for retirement, but some of these statistics can be a little staggering. So we know that pensions are becoming a little bit less common than they used to be. And according to the Secure Retirement Institute, 31% of baby boomers, 21% of Generation X, and 14% of millennials have access to a pension. With Social Security, it's accounting for about 41% of a retiree's income. So now it's more important than ever to rely on personal savings for your retirement account. And what we're looking at on this slide, this is an example of how an IRA can work and help benefit you. So an IRA, or an individual retirement account, it's a really simple, but it's a really powerful way to save for retirement. The contributions that you make to these IRA accounts during your working years, when you factor in the time frame and the way that tax-free compounding works, it can really benefit you for your retirement years. So in this graph that we're looking at right now, in this example, we've got Mr. and Mr. Vester, and they contribute $7,000 a year into an IRA over a 20-year period. Now, this investor put away about $140,000 just through contributions, but because of the compounding growth and tax deferral, we can see that this account had actually grown to about $258,000 over that 20-year time period, and that's assuming about a 6% annual return. So next, let's talk about the two different types of IRAs. So the two main types of IRAs are going to be a traditional and a Roth, and I'm sure a lot of you have heard about both of these. Both of these IRA accounts work very much the same, but there is some big differences to know between the two. So for your traditional IRAs, they're going to be funded with pre-tax money, and those contributions are usually tax deductible, which basically is going to work out to either you're going to get more money back in the year you contribute or pay less when tax time comes. And Roth IRAs work very much the same, but very differently from a tax standpoint. So the Roth IRAs, they're funded with post-tax money. So this is money that you've already paid taxes on. So you're not going to get a tax deduction in the year that you make that contribution. However, down the road, when you take the withdrawals from a Roth IRA, generally it's going to be tax-free. And the other really big benefit or difference between a traditional and a Roth is a traditional IRA at the age of 72, and it'll be 73 next year, but they're going to require you to start pulling money out of a traditional IRA, whereas a Roth, you will not have a required minimum distribution. So now let's talk about the basics. So traditional IRAs, we talked about being able to contribute. And to be able to contribute to a traditional IRA or a Roth IRA, you have to have earned income. Now, earned income is going to be defined more as like wages, or if you make a salary, if you're on commissions, basically if you get a W-2. Now, retirement income from like pensions or annuities or Social Security, that is not counted as earned income. You can contribute up to $6,000 a year into an IRA account if you're under the age of 50, assuming that you've earned at least that much. And you can contribute up to $7,000 a year if you're age 50 or older. You can make these contributions at any age and can make these contributions up until the tax filing deadline for the year prior. These contributions are deductible up to a certain income amount. So if you make more than a certain income amount, you might not be able to deduct this from your traditional IRA, but there is a little loophole, and we're going to talk about that in a few slides. One huge benefit of IRAs is the assets can grow tax deferred, and that can really add up over time. So traditional IRAs, unlike Roths, are going to require you to take that required minimum distribution at the age of 72. And again, that's going to change to age 73 starting next year in 2023. All right, now let's talk about withdrawing from a traditional IRA before age 59 and a half. So ideally, you do not want to take funds out of a retirement account before 59 and a half because you're going to be subject to a 10% IRS penalty. Let's see what happens if you do take a distribution early. There's a few exceptions that will avoid that 10% IRS penalty. So some of those more common exceptions are going to be if the IRA holder passed away, the inheritor is going to not have to wait until 59 and a half. If you become disabled as defined by Social Security, or if you're using the withdrawal for a first-time home purchase or for higher educational expenses. A little bit less common of a way to avoid that 10% IRS early withdrawal penalty is you can set up what's called a 72T. A 72T is going to allow you to take equal payments substantially before you're age 59 and a half, but there's a lot of rules that you're going to have to follow by. So again, that's something Jerry and I would be able to help you out determine if that's a good solution for you. And then next, I want to talk about withdrawing funds if you're 59 and a half or older. So you made it. You're officially retired aged. Now what? So when you withdraw from a traditional IRA, withdrawals are going to be subject to ordinary income tax. So in other words, the amount that you take out of your IRA account is going to be looked on as income, which is going to kind of depend what you would owe, from a tax standpoint. It's always a good idea to consult with your tax preparer for any kind of tax-related questions. So next, we're going to get into Roth IRAs. So just like traditionals, Roth IRAs require you to have earned income to make these contributions. They also have the same contribution limits as traditionals. An important thing to remember is you can have both traditional and Roth IRAs, but you can only contribute a total amount of either $6,000 if you're under 50 or $7,000 if you're over the age of 50. So for an example of that, let's say that you wanted to make a 6,000 contribution, and let's say you had a Roth and a traditional. You could put $3,000 into your traditional, and then you could put $3,000 into your Roth. A big difference between these IRAs is a Roth is going to grow tax-free instead of tax-deferred. Because you've already paid taxes on these funds, when you take that distribution out of a Roth account, it's going to be tax-free. Possibly the biggest difference, as I mentioned before, between these two types of IRAs is that a Roth is not going to require you to take money out at a certain age like a traditional IRA will. So you can leave those funds to grow tax-free for a longer period of time. So what about if we withdraw from a Roth IRA? So if we decide to withdraw from our Roth IRA, withdrawals are tax-free as long as these rules are met. Now, your contributions are always tax-free. So what you put into the Roth IRA will always be taken out tax-free. Now, Roths follow the best in, first out method. So contributions are withdrawn first and are always tax-free, as I mentioned. And then any conversions that have happened would be next, which we're going to talk about. In a conversion amount, they're withdrawn tax-free if the Roth has been open for more than 5 years or you're older than 59 and a half. And then next that would come out would be earnings. Now, earnings come out last and they're tax-free as long as the Roth has been open for more than 5 years and you're older than 59 and a half. So as I noted earlier, because of income limits, not everybody can contribute to a Roth IRA. So you can always convert your traditional IRA over to a Roth IRA at any time. You just have to keep in mind that what you convert from a traditional IRA to a Roth IRA is going to be taxable. So just for an example of that, if you have a $100,000 traditional IRA and you do a Roth conversion of the full amount, that will generate $100,000 of additional taxable income to your 2022 tax return. If you've previously made any non-deductible contributions to that traditional IRA, those non-deductible contributions do convert over tax-free. Assets that are held in an employer-sponsored plan, say like a 401k or a 403b, those can be converted directly from that plan to a Roth IRA. But again, going back to the taxes, if you decide that you think a conversion makes the most sense for you, Jerry and I can definitely help you on the investment side to see if it makes sense, but it is always best, and I highly recommend that you consult with a tax advisor before doing any kind of conversions over to your Roth account. So let's talk about the backdoor Roth IRA loophole, if you will. So we mentioned that you cannot contribute to a IRA account if you make more than a certain amount. Well, you can contribute, you just don't get to deduct it. So let's say that we make more than we can get a deduction from. We contribute that, or we contribute that to the IRA account. At that point, you can then convert that same amount over to a Roth IRA. And it's a little bit of a loophole to be able to contribute to a Roth IRA if your adjusted gross income is higher than the threshold. So let's talk about rollovers. There's a lot of benefits for rollovers. An option that you might have for your IRA is you can roll over a previous employer retirement account into that traditional IRA. And usually to do this, you're going to need to be separated from service from that employer, either through like a job change or if you retire. And sometimes your employer will decide to change retirement providers, which could also open up a window for a rollover option. One of the biggest benefits of doing a rollover is going to be the amount of investment options that you're going to have inside of the IRA account that you typically don't have inside of these 401ks or these 403bs. Usually with a 401k and a 403b, you're very, very limited on what that plan offers, and it's typically mutual funds. With an IRA account, you've got CDs, you've got money markets, stocks, bonds, ETFs, annuities. You just have a lot more options. There's a lot of options out there, and that's definitely something that Jerry and I will be able to help you out with. Now, we talked about some advantages of a rollover, but we also need to make sure that we kind of talk out the other side about any disadvantages for deciding to roll over funds. So let's talk about that next. So some potential disadvantages that you need to consider before deciding to roll over a previous retirement plan is going to be some employer-sponsored retirement plans will allow you to withdraw a little bit earlier than a IRA will. So some of these plans will allow you to draw as early as age 55 without having to pay that 10% early withdrawal penalty. So that's one potential benefit to check with your plan to see if that's an option for you, and if you think you'll need funds between that age 55 and 59 and a half. One of the other disadvantages is if an employee is less than a 5% owner and continues working past the age of 72, that employee can actually defer taking those required minimum distributions until they actually separate from service. And then the third option is going to be the loss of net unrealized appreciation. That's something that probably won't affect most people. That's if your employer offers shares of employer stock, which we can talk about, if you have any questions. So when can we roll over, or when can a rollover become an option? A rollover can be done when you switch jobs. It can be done when you retire. And again, some plans are going to allow you to roll over prior to the separation from service, although that's a little bit less common. But it's definitely worth inquiring about if your plan allows that, because again, options are a good thing. And simply when you have more of them, I think that's a benefit. So let's talk about those required minimum distributions and some options on what you can do with them. So option one, we can delay them. Option two, we can gift them. Option three, we can convert them. And option four, we can turn them into a guaranteed income stream. So let's talk about option one if we decide we want to delay these required minimum distributions. So first, a qualified longevity annuity contract is a way to delay your required minimum distributions. That's a specific type of an annuity contract. It's only offered by a few insurance carriers, but what it does is it does allow you to delay those RMDs until you're age 85. There are some drawbacks. So only 135,000 can be put into one of these plans, which may not be helpful if you have a significant more amount of assets in an IRA account. And it is invested in a fixed account, so that is going to also potentially limit the upside when you compare that to other investments. This isn't really one of the more common options, but again, just wanted to make sure that we covered it, just so you know. So another option is we can decide to gift our required minimum distribution. So if you decide to do a qualified charitable distribution, you are able to, once you're age 70 and a half, you can instruct the IRA custodian to set up one of these plans. And this means that the distribution of up to $100,000 per year can be sent directly to a qualified charity. This distribution is not considered taxable income to you, and it'll save the required minimum distribution requirement and satisfy that for the year. And then our next option that we talked about was if we chose to convert. So the third way to avoid RMDs is to convert a traditional IRA to a Roth IRA. Now, I want to be clear on this. You can't take the amount of your required minimum distribution and convert that to your Roth to satisfy your required minimum distribution. When I'm talking about conversion as an option, I'm talking to convert your entire traditional IRA over to a Roth. And again, if you remember, the Roths do not have a required minimum distribution that you need to take out, so you would avoid that altogether. This decision could have major tax consequences. So again, I highly suggest that you talk with your tax advisor before making that conversion. And then one of the other options is we can turn this into a guaranteed income stream. So annuities can offer income that is guaranteed for life. This can help provide peace of mind knowing that you've got dependable income. Annuities, Social Security income, pensions. I mean, those are generally the only guaranteed lifetime income options that you have. So you can definitely talk with Jerry or myself to see if like an income annuity would be a suitable choice for you. But then I want to talk a little bit more about what an annuity is, because I get that question a lot. So understanding annuities. There's a lot of different types of annuities out there, but for the sake of this presentation, I'm going to talk about annuities that are designed more around providing guaranteed income. These annuities, they can provide growth potential if they're invested. They're a way to grow your assets tax deferred. Annuities are a tax deferred vehicle. So if this is an outside funds outside of a retirement account, you still can grow these assets tax deferred. They can provide a guaranteed lifetime income stream. And some of these annuities also have really good death benefits that can help you pass those assets on to your beneficiaries, which can be very important. So guaranteed income is definitely important in retirement. So you've spent all your working life saving for retirement, and now it's the time you want to enjoy these savings, and you want to make sure that this money lasts you throughout your retirement. One of the biggest concerns I have when I'm sitting down with my members is they are just worried about running out of money in retirement. I mean, let's face it, people are living a lot longer these days. A lot of times people are retired for as long as they worked for. So we really want to make sure that we don't run out of money. An annuity can definitely help provide that guarantee. Guaranteed income can also help bridge any gaps that you might have from your working years. So if you were earning a certain amount that your lifestyle was used to, and then all of a sudden you're just on Social Security when you retire, well, an income annuity can definitely help bridge that gap to help get you back to the lifestyle that you're used to living. Okay, now let's talk about leaving IRAs to loved ones. Now, one of the most important things that you're going to take away from this webinar, in my opinion, is make sure that you name beneficiaries on all of your financial accounts. And I'm going to repeat that. Make sure you name beneficiaries on all of your financial accounts. The money avoids probate. It's easily passed on to your beneficiaries if you have them listed. You can update your beneficiaries at any time. And I'd encourage you all to actually, when we get done with this, to check on all of your financial accounts just to make sure your beneficiaries are listed to who you want your assets being passed to. Another thing with your beneficiaries is if you go through any kind of major life changes, it's a great idea to update those beneficiaries. Some of those life changes are going to be things like if you get married, if you get divorced, if you have a birth of a child, if one of your beneficiaries that you have listed has passed away. Those are going to be very, very good reasons to make sure that you circle back around and just update those beneficiaries. So speaking of beneficiaries, there's two types of beneficiaries, and let's talk about those. So two different types of beneficiaries are going to be a primary beneficiary and a contingent beneficiary. Now, a primary beneficiary, that's going to be who your assets pass to first if you were to pass away. You can have as many primary beneficiaries as you want, just as long as you designate those percentages that add up to 100%. Now, contingent beneficiaries are who the assets would pass to if all primary beneficiaries are deceased. So just like primary, you would designate a certain percentage amount to however you want to have your beneficiaries get that money. So it's a good idea to list contingents as well. And I'll give you an example of why that's a good idea. So let's say that you list your spouse as your primary beneficiary, just like many people do. And let's say that you also have children and you list your children as contingent beneficiaries. Well, now let's say you and your spouse get into a bad car accident and that causes you both to pass away. In that instance, it passes from your primary beneficiary and it would go to your contingent beneficiaries, so it would pass directly to your children. Now let's say that you're listed as a beneficiary and you inherit an IRA. You may have questions on, what kind of options you have there. So let's talk about that. So there's different options. There's different beneficiary options depending on your status. And what I mean by status is a spouse is going to have a little bit more options to them than a non-spouse will if you inherit an IRA. An option that's available only to spouses are they can actually roll that IRA into their own IRA. Now, again, that's only going to be an option for a spouse. All other options are the beneficiary can take it out as a lump sum, but again, it would be, having to pay taxes on that lump sum. So another option is you can take out that distribution over a 10-year period. So you can stretch those distributions out. And as long as you deplete that account over a 10-year period, that's all you need to do to satisfy that stretch IRA. And the reason you would do that is you could potentially reduce the amount of taxes that you would owe depending on the size of the IRA you inherit. So let's take a look at if we decide to take a lump sum. So if you choose the lump sum option, you're going to add the amount that you take out to your earned income. This might put you in a much higher tax bracket. So again, that stretch option could also be a better benefit if taxes are something that we need to consider. So look at this example of a lump sum withdrawal. $100,000 traditional IRA, the beneficiary is Jane, she's age 55, and she earns $250,000 a year. If she took this inherited IRA out as a lump sum, she's going to be adding $100,000 to her already fairly substantial income, which again could bump you up into a much higher tax bracket. So you need to make sure again that you're talking with a tax advisor when making this decision. Now let's talk about if we decide to do that stretch option, and that's going to be taking the funds out over a 10-year period. So if we choose the out in 10 option, you have to take the entire retirement balance out within 10 years. This can really help, lower the amount of taxes that are owed on the distribution, again, depending on the size of the account. It's pretty flexible in the sense that you can actually skip years of taking distributions if you want to, just as long as the account is zeroed out by the end of year 10. So let's go over some IRA to-dos. So there are important IRA to-dos every year. First, you got to open one and contribute to it if you can. You actually have until up to April 18th of 2023 to contribute to have it count towards your 2022's taxes. Obviously, if you can contribute earlier, that's going to give the funds a longer time to grow. So the earlier you can fund your retirement account, typically the better the results. All right, guys. So I hope you got some really good information from there. Today, we covered the importance of retirement savings. We talked about some of the different IRA rules between the traditional and the Roths. We also talked about some advantages and potential disadvantages of a rollover option. We talked about our required minimum distribution strategies. And then how to make an IRA work for you in retirement, especially being able to turn that into like a guaranteed income stream. And plus, we talked about the legacy planning or passing those IRA assets to your beneficiaries. So here's the contact information for myself and Jerry Johnson. If you want to jot down our contact information, we'd be happy to help you out if you have any additional questions. I'm actually going to go back and see if we had any questions listed. And speak now or forever hold your peace. And we do have a question. We have, is there a fee to speak with us? And that's a really good question. And no, our services are free of charge. There may be investments that have fees. There's a lot of them that have no fees. But again, Jerry and I can definitely go over that with you. but in terms of our services, there's no charges. Let's see if we have any other questions. All right, guys. Well, I want to thank you very, very much for your time. I hope you got some good information from this webinar. Jerry and I are here to help out any way that we can. Please feel free to reach out to us if you have any questions that you want us to address on a more personal level. But I hope you guys have a great rest of your afternoon, evening, and we will see you on the next webinar. Take care, guys.